Any better, you'd think that interest rates are at an all-time high right now, right? Back in the late 70s to the early 80s, or actually mid-80s, Paul Volcker, he was the Fed chair back then. He had federal funds rate. Now, today they're at 5.25 to 5.5. He had them as high as maybe 19 to 20%, and as low as 6%. Now, in a story out from CNBC today, this guy by the name of Altaf Kassam, he's the head of investment strategy for the EMEA at State Street Bank. Well, what's EMEA? That's Europe, Middle East, and Africa. And he says that if rates stay this high into 2025, any changes made by the Fed to help the economy are going to take longer to trickle down because classic monetary policy mechanisms, they've been broken. Now, he may have a point there, and he might actually be right, but I'd argue that they were broken by bad monetary policy in the first place, right? 5.25 to 5.5 may seem restrictive today, but in the light of the 1980s, it doesn't really seem that restrictive at all. Now, the problem is that this economy and our businesses got used to the low-rate sugar water that the Fed was handing out, which was 0% interest rates for almost 15 years. Now, you take away the punch bowl, and a lot of people leave the party, don't they? Now, the article goes on to say that if rates stay where they are, things are going to break. Well, I say things that break at 5.25 to 5.5% interest rates, well, then they really weren't built that sturdy in the first place. Now, please welcome to the show, Craig Bolanos. He's the CEO and co-founder of the Wealth Management Group in Chicago. I don't know if you echo my sentiments, but and I don't think you're old enough to remember, but I actually was looking for a car loan in 1980, and I think the APR was like 17% or something like that. It was insane. I didn't get the car, obviously. But when I hear things like this from folks, this guy's pretty well respected in the business. He's at State Street. About things being really, really restrictive at 5.25 to 5.5, I have to just roll my eyes a little bit and say, boy, you don't know how restrictive can be.
Scott, I got to tell you, this is a great example of recency bias. All of us are born to think that what happened lately is going to continue to happen. And after a decade and a half of ZRIP, zero rate interest policy, go figure, perspective has been lost. And Scott, you're correct. While I was alive in 1980, I was more concerned about my collection of Matchbox cars and how to properly cut paper with a safety scissors than I was anything else back in elementary school. But please, let's be real, everybody. I am more worried about a reinflation risk than I am refinance risk for some of the companies who are going to have their debt start to come up in 2025. So I don't think higher for longer is necessarily a terrible thing.
And when you say higher for longer, if you go back 50 years, give or take, the average Fed funds rate, where we're at we talk in terms of a range, we're at 5.25 to 5.5, is 5.42% on average for 50 years. We're right there. And so I said this on another network while I was away. It's not higher for longer. It's more normal for longer. I mean, that's really what it is.
I mean, listen, Scott, I'm in Chicago and we play 16-inch softball here. So I purposely use those words, higher for longer, because I wanted to tee it up for you to counter it to say normal for longer. Right. You and I do this all the time. Right. And people just need to have an appreciation of that. Now, don't get me wrong. If we're talking about our 401k and not wanting it to turn into a 301k, I really need to make sure the Fed still gives us at least 2 or 3 rate cuts. Anything less than 2 is going to have to reprice the market multiples in the S&P 500. So that is a hidden danger, but I think they've got this right thus far. I don't think the Fed is going to be waiting to hit their 2% target prior to lowering rates. So I still think we're going to get at least 2 shots of penicillin to keep this economy and this party going later this year.
Okay, well, if we've got housing up 6.5% year over year. You've seen what the CPI has done over the last couple 3 reads. I can't believe that cutting interest rates now is going to help bring inflation down.
No, I think cutting interest rates right now, let's remind ourselves, we're only in the middle of April, and a lot of this data is exactly that, fast data, high frequency data. I mean, the price of West Texas Intermediate crude and Brent crude certainly didn't help that most recent CPI print. Right. But at the end of the day, I think you are going to continue to see some break lower in shelter, which of course has been the most stubborn part of the inflation data. And I do think it's not just hopeful, even though I got my fingers crossed, maybe you saw it underneath the desk. I do think we're going to get some lower prints as the year goes on. And I think the Fed is going to continue to do this. Let's just hope the geopolitical turmoil doesn't get in the way.
Yeah, I mean they're definitely in a pickle because I can see 70 or 80% of the consumers out there on Main Street wanting to get an interest rate cut because of credit card bills and the likes, but at the same time they can't really afford to do that yet until they get the better numbers in that would say that, hey, we're not going to really hurt inflation. So they're kind of damned if they do, damned if they don't right now, and they need some more decisive numbers that can maybe give them that little wiggle room that they're going to need to do that. I don't see them doing it at all. I know that you've still got maybe 2 in your business plan, but unless they come in and the data is so overwhelmingly convincing that they have the ability to do that, I think that we both could be right at some point in time. I do think that the market's higher because of the expectation of cuts. And so if that market, 5% drop in that market is going to give them all the room they need to cut those interest rates. And both people that think that the market's too high and they need to cut rates could both be right at the same time. You got about 20 seconds. What do you think?
You know what? All things become clear with time. We'll get better perspective with time. I just know it's going to be really tough to justify the current pricing in of perfection led by AI enthusiasm, lower inflation, and literally a soft economic landing. I don't know, Scott. We'll just have to see. But let's use your words to close out the segment. Normal for longer. I think that's the takeaway from your important message today.
It is. It's going to be normal for long. It's not the glass is half empty. It's not the glass is half full. It's just the glass might be twice too big. That's what I say, right? So keep that in mind. Stay right there. We're going to take a look at some equity markets. I'm going to have you come back for the second segment because I've got to ask you this. You've got a lot of common sense. There's another story I want to run by you. So stay right there. We treat the symptom and not the disease. We lock up the groceries, but not the criminals that are stealing them. Now, this flies in the face of common sense, so much so that we knew who just to talk about it with. We kept him on from the first segment. That's Mr. Craig Bolanos. Craig, thanks for sticking around. I wanted to run this one by you because you have an interesting take on a lot of these things. But now, we treat the symptom and not the actual disease. But for them to say that you can't leave without giving them 6 months' notice and look for somebody to take your spot, that is so out in left field. I don't even know how you could come up with such a thing, except I have one idea, but I want to hear what you have to say first.
Well, Scott, it's so out in left field. In fact, mark this day in respect to the late Senator Feinstein. I'm actually going to agree with something she wrote in 1984 when a similar proposal was taken up when she was mayor at that time. And she said, quote, "This is an unnecessary intrusion of government regulation authority." And oh my gosh, it still holds true today. What are we working towards? A centrally planned economy where the government is actually going to own the means of production? This is absolutely ludicrous. If you didn't have homelessness, open air drug markets, and employees being attacked, that store would still be open and thriving in what used to be one of America's great cities. So this is by far nothing more than an overreach with long-term repercussions. But my question back to you, Scott, is what do you think it's worth to you as a consumer to sue a grocery store if in fact they were to close?
I mean, that is the repercussions. That's what they say that they are allowing them to do. I mean, how would you ever calculate damages? I mean, it doesn't make any sense to me, but that's perfect for California because they've also talked about, they've had such an exodus of some of their population that they're going to start to impute your earnings for the next couple of years and make you pay a tax on what you would have made if you stayed before you leave, which is terribly punitive. And I did a little bit more research, and this is something that I found out when I was living in London, but that's not a new idea, Craig. This is something that they did in Germany to keep people from leaving when Hitler became in power. Because a lot of folks there saw what was on the writing on the wall and wanted to leave, but you had to pay 2 years of tax going forward before you could. And for some reason, whether it be universal basic income or prepaying tax on imputed earnings for 2 years forward, or this idea of you can sue a grocery store that decides to leave. And how do you recruit somebody to take your spot from Whole Foods, right? Hey, it didn't work out for us, but it's going to work out for you. Don't worry, right? I mean, you could get sued by saying that. I mean, I don't understand what's coming out of that state, but every single time it seems like whatever comes across the tape is something absolutely insane.
Well, it's totally insane, and I'm not sure if this is right, but as you were talking, I had that famous song from 1976. I think that's the year going through my head, Hotel California. You may check out anytime you like. but you may never leave. That's what this sounds like to me.
Well,
so at the end of the day, it's just nothing more than another gross overreach. And what do you and I always say? Free men, free women, left to their own means, founded this country. Free markets have lifted more people up out of poverty, and all this does is prevent the free flow of capitalism into that region and that location. It just can't pass. It doesn't make any sense.
And the last thing I wanted to finish on was, if you look at what they're doing, say in Walgreens and CVS, right? You go. I haven't been in one in a while, but my wife tells me all the time. Everything is locked up now in California. It's all behind. So you have to go get somebody to unlock the things and let you get what you want to buy. That proves that we're doing the exact, because they're locking it away so that the criminals don't steal it, but they let the criminals go and we lock up the goods and services, right? So what's the next best thing from that is like, we want all of our citizens to stay home so they don't get murdered. So we're going to lock you up in your homes so you don't get murdered. I mean, that is exactly what they're showing with what they want to do with these grocery stores. To me, again, we're looking at trying to solve the wrong thing. Solve criminals, and Whole Foods doesn't leave.
I don't even know what to say because it's just that simple. But you know what, Scott? Sometimes the most obvious clue is incredibly deceptive. It's kind of like if I asked you where are my eyeglasses, you'd be like, you're wearing them, right? Yep. It's so in front of my face that you can't see the truth from, and this is, you're right. We got to clean up the homelessness, clean up the open air drug markets, make everyone go back to that very basic Maslow hierarchy of needs where you feel safe, you feel that your family is protected. And then from there, people always find a way to take care of themselves while we still create some form of a social safety net. I just think we're being dictated to here, and it is nothing more than an unnecessary overreach and government intrusion. It just worries me a bit that ideas like this even come up for debate.
I agree. How does it even happen? Thank you very much, Craig. You're the perfect common sense guy to have both of those conversations with. Craig Bolanos, he's the CEO and co-founder of the Wealth Management Group in Chicago.